right. Hello, everybody.
Hello.
Welcome to
Welcome.
another session of Dave, Bath, and Beyond, where we're all about mortgages
Mortgages and
and
more.
more. Boom. There you go.
Thank you. I'm Bathsheba Payoute, and all my information is here from Girls Capital. So I'm happy to be here and to give you some more insight.
Boom. Rocking. My name is David Dowd, and I'm with David James Investments. All my information, of course, will be right here. And we are happy to be sharing more information about the Fannie Mae guidelines as we continue our journey. Right up above us right now, you'll see a link to where we're going to be talking about those guidelines. And this recording is happening on November 3rd, when this actually went down, 2024. So we'll put up our disclaimer here as well, just to always double check the guidelines before utilizing this information or any information you find on the internet before bringing that to your customers if you're a loan officer, or if you're a customer, before putting that into the expectations and that kind of thing. So, all right, well, let's go ahead and get it kicked off. I'm going to go ahead and share my screen so we can get right into the good stuff. So we are going to be going over the legal requirements. That's B2 1.5-03 all the way through B2-1.5-05. So it's legal requirements, escrow accounts, and principal curtailments. There's that funny word again that we'll talk more about here. So we'll get kicked off with legal requirements. Let's jump over there. So first, mortgage, lien position, personal property, rental, property leases, mortgages with a capitalization option, and mortgages permitting open-end advances. Now, a lot of this is really technical. I'm going to say that right now. So if you're a customer, a lot of this you really won't need to know. But as loan officers, this is important, especially this first one.
Yes.
So start us off here. The first, mortgage lien position. So the reason why this is so important is because Fannie Mae, in most, if not all cases, are going to want to be in that first mortgage lien position. In other words, they're the first ones that get money when money gets applied to this property. So they want that because obviously that's less risk. And as we've been talking about religiously in the past 6 sessions, is basically that they want to reduce risk as much as possible. The cookie cutter thing, right? We're always talking about that, right?
Also, if you have God forbid, you have a foreclosure, they want to be the first ones to be paid out. Sometimes in homes, you have the first lien, you have a second lien, which could be a HELOC loan or a second refinance. Then you have a third lien, which could be, hey, you got your roof done, but you didn't pay the roofer. So he puts a lien on the house. So now there's an order. So that's why when they say they're the first lien, they will go ahead, and if you have to do foreclosure, they will go to the courts and say, hey, when this money comes out, I'm the first one to get paid. And then they put an order who will be second and who will be third. Typically, the roofer will be third, but it's just depending on the contract with the second lien. If they say, well, I am the second lien, I'm the second mortgage, but I want to be on first lien, then Fannie Mae has to agree to that. Usually they don't. So then that's how the role is. And that's why it's very important. And that's why they do title searching. When you do refinancing, that on top of that to see who will get paid first.
Like what other things could be there, right? I think that's something we haven't really dug too deeply into. So, right, contractors, they can have that lien. Taxation,
Yes.
if they pay the taxes, they can put a lien. Courts, judges, they can put liens depending on what happened in the court case. If you were sued and you had to pay out, or you did a settlement, that kind of thing. So couple different positions, but ultimately Fannie Mae wants to be as close to number one as possible, if possible, right? So that's what they're trying to establish here in this guideline. That being said, we're moving on next to personal property. And this is probably going to come in handy for my camp where I used to be, which is in insurance, right? Where they talk about personal property. It's like, what is personal property? Well, the best way we can describe it is if a giant picked up your home and like shook it. Everything that came out of it, that's personal property.
Oh, I love it.
Yeah. So that's what they're talking about here. It says, yeah, right. It makes it so simple. I was so glad when I learned that. I did not come up with that originally. I'm not going to take credit for that. But when I learned about that, I was like, yeah, okay, that makes a lot of sense. It makes it really easy to understand. So yeah, anything that's not permanently attached is how they'll define it in the insurance industry and probably in like contracting and things like that. But they're basically saying, hey, when it comes to personal property, it may not be included as additional security. That is to go against the risk if you will, right? For any mortgage on a one-unit property unless otherwise specified by Fannie Mae. You can't use your furniture, for example, or you can't
Yes,
use the appliances like your fridge and things like that.
as a down payment for the house. You can't use
Exactly. And up for security as well. So like, I
it.
guess if we're looking at assets and things like that, they're saying let's not do that because, and I don't know if that has to do anything with like the risk, most likely because everything's varying in terms of the amounts and things like that, the values of certain items, but it doesn't really say that here. So let's go with the guidelines on this one, I think.
These appliances, they have depreciating value. I know our jewelry usually appreciates, but it's like you said, it's not what they want because it's easily can get up and walk away, like you said. So
Get the legs, right? The legs on. Well, where did it go? Just get grow some
yeah.
legs and walk away. It did. Yes, it did. Absolutely. The gnomes or the elves, they did what they did.
Yes.
All right. Well, let's see. Rental property leases. Just going to go through that one really quickly. It says leases that predate the mortgage could have a superior claim to the mortgage. Furthermore, state laws may differ on the relationship between an unrecorded lease and a subsequent mortgage. The lender is responsible for ensuring clear title and first lien enforceability in accordance with, and it references a section there. So that's basically just saying, hey, you know what? If they're not first lien, we're going to put this on the lender. Okay. They're going to make sure that if this goes off the rails, the lender's the one that's going to be responsible. That's what that's trying to establish, especially when it comes to rental properties. So mortgages with a capitalization option. So I'm just going to review that as well since it's relatively short. Some mortgage instruments permit the note holder to capitalize delinquent interest or sums to advanced to pay insurance premiums, property taxes, or other expenses required to protect the value of security property by adding them to the outstanding principal balance of the mortgage. Fannie Mae will not purchase or securitize mortgages where any such funds have been capitalized or advanced by the note holder prior to delivery to Fannie Mae. So that is a bit to unpack there, but let's see here. So advanced pay insurance, it's just looking at the property's value, and that's what it's trying to focus in on. It doesn't want to find all these little creative financing directions with capitalization options. They're trying to eliminate that. Now, obviously, your mileage may vary in terms of what they will allow. That's always going to be a thing that's on the table. So definitely talk to your loan officer about that. But ultimately, they're trying to avoid that because I guess it's just too many questions come up a lot of times, and that requires more work. And remember, cookie cutter, right? Make it simple, goes through the line, that kind of thing.
Do you think this could turn into like an negative amortization because they're adding the interest to the unpaid? So now it's just the mortgages keep growing and growing and growing.
Right. That could definitely be one of the many reasons that they don't want it.
Right,
It's more of a
right,
non-QM or non-qualified
right,
mortgage direction
right,
instead of Fannie Mae conventional, Freddie Mac, that kind of thing. That
right.
definitely could be one of them because as we've learned from previous lessons, negative amortization is unacceptable. They don't want that because then that leaves the buyer in dire straits a lot of times. They're never going to get to that principal. They're just paying
Right.
interest upon interest upon interest. And now the interest is building the interest, and that's a mess. That's a big
Yeah.
mess. The last section, of course, is mortgages permitting open-end advances. So final technical piece here. Fannie Mae purchases or securitizes a mortgage that includes an open-end advance provision only if the provision gives Fannie Mae the option not to make any advances. If funds were advanced prior to delivery, the transaction is considered a modified mortgage that is not eligible for delivery, as we've talked about in previous lessons. So definitely check that out. I'll probably put a link up here on that previous lesson where we talked about that. It's saying, hey, we don't want this because again, it can cause those things that are unacceptable, and then they got to do more work in order to make sure that
Right.
something they end up having. So
Right. It can lead back to that negative amortization where it's like a credit card, like a revolving
yeah,
credit card. You keep taking money out and put it in, and then you're just paying the minimum, or you're just paying the interest. So you're never really catching up.
you're just in this race, this uphill battle, and you keep rolling down the hill, that kind of thing.
Right.
You're trying to, and then you come back down. So that's negative
Yeah.
amortization. That's the feeling.
We're going to talk about escrow accounts, and that's where,
Escrow. In this section, we're going to be covering the escrow accounts and the escrow waivers.
yes.
And so for those that are not familiar with the mortgage industry and what escrow accounts are, we are going to be telling you what that is. So I'm going to give you the simple version first.
Yes.
Escrow is an account that money
Yes.
can be placed in. So just like a bank account. And what it represents is going to be what makes up your expenses as a homeowner, right? So in addition to what the mortgage is, which is interest and principal, it's also
Right.
going to include your homeowner's insurance as well as your taxes,
Taxes.
property taxes. And
Yes.
then, if applicable, your mortgage insurance. So that's for the lender, remember, not the homeowners, and homeowners
Yes.
insurance, mortgage insurance, different things. So keep that in mind.
Right.
They sound the same, but they are different. So all of that together, and mainly the big thing here is that it's going to be putting that aside. So when it comes time to pay your taxes, when it comes to time to pay your insurance, all of that's getting taken care of. So all you got to worry about is the mortgage payment, which includes all those pieces in that account. So that's escrow, is just a special account. And most people will need that. And in this section, they're going to talk about why someone would need that. Okay.
It is an account that you don't create. It is something that the lender creates on your behalf. And you pay a full amount of what David said, the mortgage. If you have mortgage insurance is like PMI or MIP for FHA, your taxes and your homeowner's insurance, and sometimes your HOAs too. So all those 5 pieces go, and then they send you a bill that lets you know how much is in it. And if you have more than $50 in there, then they have to return it back to you. But if you're less, they'll send you a letter saying, hey, you're short. And that's not always a fixed amount, because they can't fix the homeowner's insurance, and they can't fix the taxes. So sometimes they'd be like, oh, you have to pay a little bit more, or you have to pay a little less. So they will let you know that. And then you'll have to pay that sometimes for 5 years or through the duration of the loan. And the way that they get paid for servicing the mortgage is they take a percentage every time. We don't really feel it, but it's in there.
I'll tell you one other thing here, a little bit of an insider on the insurance side of things. So when your homeowner's insurance is getting paid by the mortgage servicer in this case, right?
Yes.
They're going to pay that thing in full. Okay. So
Oh,
it's in insurance, it's always a year. Okay. So
right.
homeowner's insurance is always a year. It's never 6 months like auto insurance is. It's a full annual thing. And the mortgage servicer will pay that upfront in full. And they're going to get back from you over the months as you pay your mortgage, that piece that represents the insurance every month. And that's how they get their money back. When that becomes an issue is when your loan gets sold to another mortgage service provider.
Oh,
Then you got that 6 month range that you got to make sure that everybody's on the same page. Otherwise, you may go uninsured because your insurance doesn't get paid. And I've seen that happen before, and that can be kind of scary. So if you ever get a notice that says, hey, your mortgage has been sold to this new service provider, which can happen, and you have no control over that, by the way.
right.
If that happens, make sure that the new service provider knows what insurance you have, and make sure that they call your insurance and make sure that they are the ones listed there when that time happens. So you can avoid that whole being uninsured for any period of time, because that can be a big mess, especially when you think it's all being taken care of and it's not. You as the customer are going to get a lot of time, but don't let
Yes.
that be the reason you procrastinate on making sure everyone's good. Like, at the end of the day, it
Yes.
is your mortgage, it is your home.
Yes.
And even though you didn't have control of it being sold, that's why they give you so many days to go in there and do it, because maybe you're busy. When it comes to the escrow, like Bathsheba was saying, you may get refunded some amount if you've overpaid. Now, that's going to vary depending on state guidelines. That's going to vary depending on what happens with taxes and other things like that.
So with the escrow, they will let you know in advance. Very important that you're aware of it. You read over it to make sure everything is getting paid accordingly, that you're taking care of things properly. And some people don't have to do escrow. It's just depending on your interest rate. It's depending upon your credit score. Sometimes you can get an escrow waiver and say, hey, I can pay my own insurance. I can pay my own mortgage note. That's just depending on, if that option is there for your lender. And that is a good incentive too, because then that will help reduce your monthly payment. That will help reduce your closing and so forth.
In essence, Fannie Mae is going to want escrow accounts to be established in most cases, especially with first-time home buyers, and also maybe high risk. That's another thing too. They're kind of looking at the profile of a borrower. That's what they're establishing here when they're saying, hey, who needs to have an escrow account? It's those people. Don't be offended if they have an escrow account. Actually, it works out pretty nice. I like having an escrow account myself for my own personal home, because it really helps to make sure my taxes are taken care of and my insurance.
Right.
How do you feel
It's
about escrow accounts
Yeah,
ultimately?
it's a convenience. It's a convenience portion of it. So now you don't have to worry about paying it. Like I said, you don't have to worry about, well, who do I pay for my mortgage? Who I pay for my taxes? Who do I pay for my HOA? Who do I pay? They do all of that for you. That's why they're your servicers. They do it all for you at one time. So it is a convenience portion of it. That's the benefit of having an escrow. You just have to be on top of it because they send you a letter and a statement. Sometimes you'll have more in there, or sometimes they'll be like, hey, we need to add additional funds in it to take care of the increase of your taxes or the increase of your homeowner's insurance. Because here in Florida, ours is just fluctuating.
It also talks about flood insurance, and I think for California, it may even include earthquake insurance as well. So a
Yeah.
couple of varying types of insurance depending on where you live, right? So I imagine Florida probably has flood zones like Texas does.
Mhm.
That may be a part of what you're paying as those premiums go. With that being said, the other section of this is going to be the escrow waivers. So, like when you can have escrow versus when you want to waive having an escrow account. Personally, I don't see the point, but I guess for some people that have different setups with their taxes and with their finances, maybe it works out better for them to have waivers because they can invest that money elsewhere instead of having it stuck in an escrow account. But it's usually more experienced folks, people that have a high net worth, things like that. A lot of times that's when I've seen this, but perhaps that's something you prefer also. Maybe it's a preference. So you just got to kind of look and see, hey, can I get my escrow account waived? Ask your lender if that's possible. And if they say yes, then you also have to look at what are the conditions depending on who's doing the loan, right? So if Fannie Mae is doing it, you're going to get a lot of pushback probably. Whereas with maybe like a non-QM product or perhaps a VA, they're maybe not as strict. So your mileage may vary there.
If you have like a refi, like a refinance, you want to refinance your home, usually there is an option to waive your escrow, and that can help with, like I said, your monthly payments and so forth. So, like it says in the beginning, Fannie Mae advocates the establishment of an escrow account for payments of taxes and insurance, particularly for borrowers with blemished credit history or first-time buyers. So, like we said, if you're not a seasoned homeowner, and there's so much to get into with home ownership, like once you become a homeowner, there's so much you got to work on getting these documents. You're getting all sorts of documents. Sometimes you're getting spam documents. You have to really read it and make sure, well, is this legit? You
Yeah.
got to do your homework to make sure it's not a scammer. At least with your escrow, you know who to pay because you've been talking to your lender that you trust. They're going to make you aware of who to expect, who's going to mail you out, so you don't have to worry about that portion of it. Or if you have a blemish on your credit history, maybe you have too many letters and sometimes you forget things. So this helps you to get organized, or the convenience of it. But with escrow waiver, if you're on top of it, you're doing a refi, you're not new to it, then definitely take advantage of the escrow waiver. But
Yeah,
if
me
you
too.
like convenience, then it's always there for you.
Here's one tip that I wanted to add in. For me personally, how
Mm-hmm.
I pay my mortgage is I have a savings account, a high yield savings account set up. And I just put
Uh-huh.
all the money that's going to go to my mortgage in there. So if I can have that a few months in advance, that'd be really nice. But obviously, I'm getting interest from that. That's probably higher
Yeah,
than other things. And then I just pay the mortgage when it is due. That, in a sense, is kind of like my pseudo escrow account in a
escrow.
sense.
What the escrow is doing, like they
Right.
put the money in there, they put in a high yield savings, and then they get the profit from it. You
Right.
know,
They get that profit. Yeah, you don't, but
they
they
get that profit. You don't.
yeah. If you wanted to waive your escrow, then I suggest that setup. So that way you can get some benefit from that setup. If you're eligible to do that, if you're comfortable with that, because it's very important to comfort, right? Like,
Yeah.
am I going to remember all these things? How much of this can I automate? That's another thing you need to ask yourself. How comfortable am I with automation? Folks like myself, it's like automation is kind of scary because it's like, am I going to have the money in that account by the time they,
Right. What if something happens? What if my check
right?
didn't go and they take it out? Then, but if you have good history with your bank, I'm the one to be like, hey, I've been with you guys since I was 15, and that was like 5 years ago, guys.
Right.
You guys need to take care of it. But definitely, I love the idea of the high yield savings. It's the best way to save your funds, and you get the interest while you make sure you're paying. And even like what I do is like my cushion, my 8 months cushion, I put it in a CD. So for
Oh, nice.
5 months, so if anything happens, then I'll be able to get the funds. And that funded specifically for our home. It's like a type of insurance.
So I guess we've covered everything on escrow accounts, guys. So definitely leave your questions in the comments below, wherever you're watching this. We can always get back to you or reach out to us in our information that we'll show again at the end of the video. Let's get back to our final section here today, which is going to be the principal curtailments. Oh boy, fancy word, curtailments.
Back
Right?
again with you. I think we talked about the last episode.
Yes, we did. Yes, we did. But in case you missed it or you need a refresher, curtailments is to restrict or to reduce is what that means. So anytime you see that word, that's what it means. Okay, so that kind of eliminates the jargon a little bit. What I found really cool, I found something pretty cool in this one I'm going to bring up here in a second. But so you get these curtailments. So I'm going to read the overview really quickly for us. A principal curtailment is the application of funds that are used to reduce the unpaid principal balance of the mortgage loan. Fannie Mae permits certain curtailments prior to loan delivery, provided that the delivery data reflects the curtailment as described below. So they have specifications about what is an acceptable curtailment or reduction, right? So Fannie Mae permits curtailments for the following reasons. The lender may apply a curtailment to refund the overpayment of fees or charges paid by the borrower in any amount, as a side note, in accordance with applicable regulatory requirements. So still got to stick to the books there. And then we have a big example, which I'll talk about more in a second, but we'll jump to the third one real quick. Fannie Mae also allows additional principal payments remitted by a borrower to prepay, the mortgage loan as permitted by the loan documents. And this includes curtailments applied to the principal balance to reduce the monthly mortgage payment, which is really nice if you can do that, because then your monthly is less, and that's the one you're going to see every month. So that's why that's important. So here's the big one. All right. So it says if the borrower receives more cash, this is the second bullet point, guys. If the borrower receives more cash back than is permitted for a limited cash out refinances, which I'll leave a link up here for that video about when we talked about that, the lender can apply a curtailment to reduce the amount of cash back to the borrower to bring to the loan into compliance with the maximum cash back requirement. So why this is important is because let's say you wanted to do a limited cash out. In other words, you wanted to retain where you are in the loan. You have a 30-year loan, you paid 3 years, so now you got 27 years left. You want to stay there, but you still want to do a refinance to reduce your interest rate, right, for your monthly. So if you take out more than, right here, I'm going to highlight it, $2,500 or 2% of the original loan amount. It doesn't say it there, but I'm pretty sure it's going to be whichever one is the lesser. But if you take out more than that, then it's no longer a limited cash out refinance. Now it's a cash out refinance, which has
a regular cash out, full out cash
over from to year 30 again, right? That's what that would force you to do. So what they can do with a curtailment, this is the cool part here, is they can take, let's say in this example, right? Let's say the borrower gets more than that $2,500, they get $3,500. Oh my God. But I want to do same term, right? I want to retain that I'm 27 years into this mortgage. I don't want to go back to year 30.
Yeah, I don't want to start over.
Exactly. So we, as the lender, can do a curtailment of the amount that makes it lesser than that amount. So in this example, they do 1,500 curtailment. See, right there?
Right.
Prior to going to Fannie Mae. So Fannie Mae is just seeing what they need to see in order to retain the limited cash out refinance that they want, the same term. So we did that. But then you might be wondering, where does that money go? Like, you guys reduced money you owed me. So where did it go? Well, they don't tell you this, but it's actually up here where it goes. And it's like, it goes to reduce the principal balance. But it doesn't say that. It doesn't say refer back to what we said a second ago. No, it just goes into it here. So that's what got a little confusing when I first read this. Right. But I saw that and I said, oh, wow. Okay. So it goes that extra money, instead of going back into your pocket right now, it goes into your pocket over the life of the loan, basically, because it's going to go towards that directly to principal and ultimately help out a little bit on the monthly, as well as cutting back that interest, right? That's the most important part. So that's the beauty of curtailments. If we want to have that experience, right? This is what we want. We want to keep the same mortgage, same term. We don't want to start over. That's why they would have done this. So
they don't pocket any of the money?
Right. In this example, they talk about cash back to closing on the loan amount. So when they were closing it and they did all the math, right. They said, hey, we owe you $3,500.
Right,
That accesses what Fannie Mae says about limited cash out refinances, their guidelines.
right,
So they said, oh, okay, let's just chop off 1,500. I mean, they didn't have to do 1,500. They could have done 1,000, but
right,
let's not take any chances here. Let's make sure it's well under the limit amount,
right. The 25,
1,500.
right.
So they're going to the table to Fannie Mae and say, hey, I'm only getting $2,000 from this transaction. And that 1,500, it got applied to the principal balance of the mortgage.
Ah, okay.
Yeah, so that's where it went because it's like, well, where'd my money go? Right? Everyone wants to
Right,
know that. That's very important. You should ask that. If you're not asking that question, let this be the video that says always ask that question, please.
right.
But yeah,
I
this
got
in this case, would go to the principal because they can't use it in closing the transaction because then Fannie
right,
would see that, oh, it came out and then it went over here. No, no, no. It went to principal. It's like as if that principal just got paid beforehand with the
right.
cash out. That's where it went. You don't want to make sure that anything that's being said expectation wise is in writing. You know,
Yes,
it's so important because things can change. And
yes,
if they do, you want to make sure that you can present original expectations as much as possible because
yes,
maybe you didn't have control over those changes, but maybe they make the exception because, hey, look, I got it. This was the original expectation. So it doesn't always work out that way, but at least to give yourself that fighting chance in the beginning. If the curtailment is made at the time of closing, the amount must be clearly documented on the settlement statement. They'll know that it happened, but
right,
they'll know in the sense of, oh, okay, well, we're not going to worry about it because it happened before we got it, Fannie Mae saying.
right,
So if the curtailment is applied after closing, but before delivery, the mortgage loan file or servicing file must be documented with the amount of the curtailment and the reason or source of the curtailment, for example, the lender refund or borrower initiated, and include any modification agreement used to reduce the monthly payment following the application of the curtailment. So, layman's terms, if you're doing a curtailment, we need to know why. It needs to be
yeah.
documented.
Who and why? Yes.
Yep. Yeah, where did it come from, right?
Documentation is very important. As David said, we need to know why. Fannie Mae needs to know why. So it'll be a clear closing so it doesn't get into limbos. Everything gets taken care of.
And then lastly, the delivery instructions, where it just says refer to the loan modifications job aid for the delivery of loans impacted by the curtailment applied prior to the delivery of the loan to Fannie Mae so that they don't interpret your loan as a modified loan, which means they may deny the going to Fannie Mae, which may cause other issues, which we don't want. So it's just
Right.
keeping it safe, delivery. Okay, I think that's everything on the principal curtailment section here. Yeah, I mean, there's an insurance for just about everything under the sun at this point. Some football players, even parts of their body are insured. It's
Wow.
known as a floater. That's what they call those things. Specific, but not very common things. So, like a football player might insure his legs because without that, he can't play football. So if he's
Right.
out for the season, he's got an insurance policy in case that happens to keep paying him his lifestyle. Or an artist insures their hands because without that, they
Right.
don't have any art. Yeah,
Right.
they're expensive policies. It should be noted. So if you're going to do something like that, it's usually because you got money. But yeah, they're called floaters and they're very specific. Mortgage protection insurance. If you've got people depending on your income, it's
Mhm.
important to consider things like that because like let's say, it's you and your partner living in the house, but you're the only one working and you got kids. It's like, well, if you guys don't have life insurance,
Right.
that could be a problem. If you guys don't have, like you said, the mortgage insurance, like mortgage payment insurance, I should say, because obviously we're
Right.
going to mix that up with something else.
Yeah. The
Um,
mortgage insurance protects the lender. Now,
right,
us as the borrower, what is our protection? And that's what the mortgage protection insurance is for.
exactly. But see what a lot of people forget, because when they hear the words mortgage insurance and how it's not protecting them, they get
Mhm.
really offensive. They get very defensive. Right? Oh
Mhm.
my God, no, I don't want to pay that. Oh my God. But we have to think also, it allows you to be able to take on something you would normally not be able to take on.
Right.
Think of it that way. It's giving you the opportunity to get in now instead of waiting until you've saved up 20% for the down payment
Mhm.
or however much the percentage is going to be that you're going to do. You can do it now thanks to mortgage insurance. When that invention came to the industry, it allowed more people to get houses sooner than later. In a way, yes, it is protecting the interest at the core of the lender in case you default and go into foreclosure.
Right.
but it also gives you an opportunity. Yeah, you're paying a little bit, but you can work that out later in terms of getting rid of the mortgage insurance, right? Conventional, 20% and below. As soon as you've reached that mark, you can call it in.
And calling in.
Let's get rid of it. I'm under 80%. Let's get rid of it because it won't go away on its own until 78%. Very important, right?
It won't. But
We have to-
we'll leave it for our audience. So I'm going to ask our audience, do you know any good mortgage protection insurance? Have you heard of it before? Have you experienced it? Let us know in the chats below so we can do our research and see what will be best for us and we could relate a reference to our clients.
Oh yeah. Yeah. As we're setting up things and as we're trying to really reach out to people that are like, in a financial advisory type positions where let's see what they think about these things, estate planning, even if you will.
Yeah.
It's something important to consider, especially as you get these larger purchases in your life, like a home. If something happens to you, my goodness, like it's a house of cards, right? So it's something important to think about. Obviously, there's a cost behind it, so you got to consider that too. But hopefully, in the weighing of risk and how much risk you can fathom, this is some of the things you can talk about with your financial advisor too. But definitely in the comments below, tell us your thoughts and maybe what you're doing to make sure your risk is reduced.
Yes.
Insurances, I think that's
Protect
important too.
yourself. Sharing is caring. I hope you guys enjoyed my nice little view. You guys positive.
Right? Was that the Golden Gate Bridge? Is that?
Yes.
This is the bridge. Okay, cool. I'm like, maybe, something else. But yeah, no. We're going to leave all of our information right here for all of us. If you want to get in contact with us, definitely reach out. We'll be able to help you make one of the biggest financial decisions of your life, most likely.
Yes.
And obviously, we're so happy to be able to share this knowledge with you guys. It's always a joy. It's always a privilege as we get close to the end here.
Can't wait to see you guys on the next episode. And thank you, David, for having me as always.
Absolutely. Absolutely. Always a pleasure. Well, guys, be blessed. Have a great rest of your day. And we'll see you in the next one. So bye for now, guys.
Bye.